Welcome to the Daily Brief, where I'll go over the action in the market for Monday, March 13th, and then we'll see how things look for Tuesday, March 14th. We had another down day. It was a little hard for me to keep track of things because Stock Charts was having a problem with their intraday data, so I couldn't really follow the ups and downs of the session. I did find another chart on Yahoo Finance that I'll show you here in just a moment. But the big news item right now appears to be what's going on in the banking sector. I have some charts to show you. The question that I'm trying to focus in on is, okay, we know bad things are happening and that's going to affect a lot of people. But is it going to stay small or is it going to grow and get bigger as we go forth from here? And I'll discuss that a little bit in this video. So let's go back and talk about what happened. I don't have the intraday information just because the chart was not updated. We ended up being down 0.15%, virtually unchanged, but at the same time still a down day. Volume is still above average. It was a very interesting weekend for a lot of folks. They saw what was happening on Thursday and Friday. They saw the shutdown of Silicon Valley Bank. Over the weekend, there were a lot of officials going about doing things and saying certain things will happen. And then Monday, people come and say, well, I better get out of this, or I better get out of that, or I better change what I'm already doing. That added to some initial bouncing around in the markets. And what was interesting is even though we closed down and opened lower on the session, the futures were actually up almost 2% during the night. They fell back down and actually went negative, but that's kind of interesting how things are really happening right now. The technicals are still negative overall, but we're continuing to be oversold. We're not getting much of a bounce yet. We are moving a little bit sideways with the slight down day, so that's wearing off some of our very short-term indicators, such as one day to the next. But we're still oversold in the short and intermediate term. The inflation and interest rate scenario is still at the forefront, even though it's not making the headlines right now. But it will come back to being the headline because on Tuesday we'll get the CPI that will be coming out. And now we're trying to wonder, is this a banking contagion? Meaning that it starts in one place small and seems to be isolated, but when it's a contagion, then it starts to grow and affect other sectors and also the entire market overall. And could this even blow up into some kind of a global situation? Here's the intraday chart from Yahoo, way over on the right-hand side, showing how we had a flat to slightly higher open here from Friday's close. Bounced around quite a bit. What it looked like was happening right at the beginning of the day, but it was a little hard for me to see, is they purposely gapped things down because a lot of people over the weekend decided to sell. Once that was done and all those orders were executed, they tried to take things up higher. And that did work for a while, but we hit resistance up here at the 3,900 level before falling back. We tried to go back up again. That wasn't happening. So we ended up closing just down slightly on the day. What are some comments that we can make? The banking sector fallout still continues. And I'm calling this a sector, not in the S&P 500 sector definition. This is just a big group that does similar things. Very related to this is bank stocks continue to lead the market lower. That's a lot of the overhead pressure that we're seeing right now. On a short-term basis, we have our advanced decline ratio, the rate of change going back 5 periods. Stochastic, Stoch RSI, Williams percent R, and the Force Index are all extreme negative and could be considered oversold. On an intermediate term basis, we have our 9-period VIX, the Arun, the moving average study, the Swinland Trading Oscillator, that's a new addition to the list, the McClellan Oscillator, the PMO study, the BPI, that's a new addition also, the CCI 14 and 20, as well as the RSI 9. The dollar was down and interest rates were also down. That could have given some support to stocks, but we're continuing to see this flight to safety as folks are getting out of stocks and going into bonds. That's pushing bond prices up and interest rates down. We have one of our yield curves, the 30 to the 5-year. It's no longer inverted right now, but we've seen that happen before where it goes regular for a few days and then goes back to being inverted. So we'll keep an eye on that. Sentiment is really extreme right now. We're down at the 20 range where we fell from Friday at 22. Our trend is still negative, but it's getting stronger. We're crossing above the moving average. So if you're more aggressive, you like this already and you might take advantage of this. But please be warned that we are quite oversold right now, and we still have some support below where we're at. So the market may get that oversold condition, hit support, and then try to bounce up from there at some point. But the ADX continues to be below 20. Our bias is negative, and our momentum is negative. We didn't have any economic reports that came out on Monday. And then here's some notes that I picked up along the way about what's going on in the banking sector. The Federal Reserve, the Treasury, and the FDIC made a joint statement saying that all depositors at Silicon Valley Bank and Signature Bank in New York would be fully protected, even though both banks have been taken over by regulators. So that was meant to calm things down a bit. Also, the Fed introduced this thing called the BTFP, the Bank Term Funding Program, that will help banks avert selling Treasury and other government securities. That's basically what was happening now. A lot of these banks, they're going out, they're buying treasuries and mortgage-backed securities, and they're returning very low rates. But there's a maturity on these. They have to hold on to them for a period of time. As rates have been going up, and people are saying, give me my money, give me my money. Well, they're like, okay, the only way we can get some money is to sell these assets that we already have, and we're going to have to sell those for a loss. And you just compound that over and over, and that led to a large part of the problem. This BTFP is to try to prevent those losses by allowing them to offer those securities to the Fed, okay, hence the taxpayer, which will value them at par, meaning there's no loss right there, and then that can be used as collateral. Whether you agree or disagree with this is what's happening right now. You may totally believe that this is what needs to be done, but on the other hand, you're like, wait a minute, this is the government stepping in and taking more control. I don't want that. The idea behind what we do when we analyze the market is not to have an opinion one way or another. We just take things for what they are and then deal with how the market reacts to that, whether positive or negative. The idea behind this was done to restore some normalcy to the banking system and to calm the stock market, basically. But this really hasn't helped. It didn't help in Monday's session. We saw a lot of bouncing around, and I'll show you some charts. And so what they're trying to guard against right now is maybe this is bigger than we thought before. The one positive side is a lot of the podcasts I listen to, a lot of the news sources that I consult, they're leading with this information. And so this makes it more pop news. Everybody's focused on right now and everybody's talking about, but it quickly goes away in 2 or 3 news cycles from now. That would be the good side. The other side is, okay, maybe something bad is happening here, and then eventually it's going to get even worse. This is also starting to affect some other banks, such as First Republic Bank, Western Alliance Bancorp, Co-America, and PacWest Bancorp. Jumping back over to interest rates, this is where we were as of Friday, March 3rd, looking at a 71.6% chance that there'll be a 25 basis point hike at the next meeting. This is what it jumped to after Fed Chair Powell gave his testimony last week. This is what it's at currently. This had fallen a little bit in Friday's session, thinking that, well, if all these banks are running into trouble, maybe the Fed won't raise rates after all, or maybe they won't raise them as much, or heaven forbid that they might even cut rates. So those are the different scenarios that are flying around right now. The Ulcer Index is just about back up to the moving average currently, and the VIX is really seeing a spike up because of this fear that's entering into the market. So on a closing basis with the line chart, we're really going up, and the bar chart is really going up too, even though we closed in about the middle of that bar. The VIX of the VIX is also spiking up, showing that volatility of the VIX is really increasing. Here's the VIX looking at the RSI 9 period, where we're starting to get extreme, meaning that the VIX has gone up pretty far, pretty fast. This is the condition of our trend, showing that the red line's on top, so we default to the negative. The ADX is crossing above the moving average now, so this could be the beginning of a new trend. And like I said, if you're more aggressive, you're jumping all over this. If you're more conservative, you want to wait until this line crosses above 20. But this does look to be developing as a negative trend, but also be aware that we are oversold. Here's the daily chart showing how we broke down below this declining trend line. We went right back up to this level. That was pretty much the high at the 3,900 level before coming back down. Here's the 2-year look at that same chart. We did close down below S1, a pivot level for the month. So that is also more negative, but we were already below that after Friday's session. And then at the bottom, you see where volume has just really spiked up. The Arun is also very negative. The red line's on top showing sellers are in control. The buyers are starting to go down to the bottom and going sideways overall. So that's more negative. When you look at our oscillator, we're almost pegged near the bottom, so that's extreme negative, but it is still negative nonetheless. This is how things shaped up, where we had large cap growth was actually up on the day, where value is the one that's just been getting hammered in all of the different areas, large, mid cap, and small cap. As we've been going down, that's starting to increase fear, which is pushing more towards this risk-off type of environment, where folks are getting out of stocks and going into bonds. Risk on is when they get out of bonds and go back into stocks. This also is suggesting that fear is continuing to go up. We read this chart similar to how we read the VIX. Stochc RSI is extreme negative, as is the Williams percent R. Even though it turned up slightly, it still hasn't generated an official oversold condition yet. That'll be when it crosses above that line. The Force Index is also extreme negative, hitting the lower Keltner band, which shows that we've gone down pretty far, pretty fast. Stochastic, on a short-term basis, still extreme negative, although it's turning up. Intermediate term, getting extreme. Just starting to enter in extreme negative territory with the long-term stochastic chart. Going back 5 periods, we're still getting extreme with the rate of change. And the standard deviation study showing that we're still dancing around here in this third standard deviation area, which means that we've gone down pretty far, pretty fast. Our moving average tree is just showing that we're below all of the plotted moving averages. The RSI on 9 period is starting to go extreme negative. The parabolic SAR continues to be negative with the dots on top. Chaikin oscillator continuing to decline. You could make a case to say that we're starting to get extreme negative with this, but it could still go even lower. PMO study, with those percent of PMOs that are rising, still extreme negative even though it turned up slightly. The buy signals are extreme negative, and the PMOs that are above zero continues to decline. This is a new addition where the Swinland Trading Oscillator based on price and volume are starting to go extreme negative. The BPI dropped below 30, also starting to get extreme negative. The NYSE Bullish Percent Index, it's not below 30 yet, that's this red line, but it is showing a real decline on a broad base. Chaikin money flow continues to be negative and is declining. Moving average study, turning up a little bit with our 20, but still extreme negative. Pretty much flat to trying to turn back up with our 50, and still declining with the 200-day exponential moving average. CCI 14 and the CCI 20 continue to be extreme negative. Balance of power turned back up slightly, but it's still negative since it's below the dashed line. TTM squeeze, we still have red bars that are getting larger as we decline, so that's negative. The go, no-go, we're still stuck in deep purple land, so that is negative. Here's a new chart showing the anchored moving average from the COVID low. That's supposed to be this orange one here. I couldn't find an orange for my text on here. And then we have another anchored moving average going back to the all-time high. You can't see those on this chart. It would make it too long. But we're looking to see, are one of these moving averages going to provide some support? Short-term fib levels, we came down to this 38.06 or 38.08 level. The low was actually at 38.08, so that means this support is holding right now, and we have a double fib level right here. Our long-term fib chart showing that we still have some support down at 38.26 or so. I don't have the intermediate term fib chart now because we're just drifting out, not even near any kind of a support level. Here's the weekly chart also showing what could potentially be support. We're looking at this 38.2% retracement at 39.09. So we're waiting to see if this level holds. If we drop below that, then we're going down to the 200-week moving average, which is currently at the 37.31 level. Elder impulse system for the S&P is red, so that's negative. The McClellan oscillator still extreme negative, turned up slightly, but is still negative overall. The broader range McClellan oscillator is still going down and extreme negative. Summation index based on price and volume, well below zero and declining. That's negative. New highs, new lows, starting to see the new lows expand. So that is sending our 5-period simple moving average down. And our 10-period is now dropping below zero and declining. Advanced decline line, we're below based on price and volume. Advanced decline ratio, starting to get extreme with our 19-period exponential moving average. Still declining with the red line, which is a 39 exponential moving average. Accumulation distribution below the moving average, and the moving average is now starting to turn down. Volume is starting to pick up. Here's the ratio between the financial sector and the S&P 500, showing how the financials have just fallen off a cliff lately. Here's another chart showing the bank ETF, where it has really fallen. It was down almost 10% in Monday's session. Here's another regional bank ETF showing how this has just really suffered a lot of loss. Another regional banking ETF. And then here's a ratio showing the regional banking ETF and comparing it to the financial sector. It's really underperforming, which could be positive in a way. That means that the financial sector is holding up a little bit better. So far, this has been contained into some of these regional banks. And if it can just stay there and get dealt with, that could be positive for the market. If it starts to spread, then we would see the financial sector really start to take it on the chin as well. That could then bleed over into the larger market. Here's a chart showing the S&P 500, which is a weighted index, and then comparing it to the equal weight index. Shows how the S&P 500, the bigger stocks, are starting to outperform the rest of the S&P 500. So this could be a background positive aspect that's going on right now. The Dow is still below this S1 support level and below both the 50 and 200-day moving averages. The diamonds are negative. The NASDAQ also below both moving averages, still staying above this S1 level. So we're seeing if the NASDAQ can find some support. And then the NASDAQ 100 is still above this S1 level as well. We're getting really close to a golden cross, so there could be some potential positive backdrops developing. The Qs, however, continue to be negative. Small caps really getting hit hard lately. Here's another look where they really have fallen down. The RSI is starting to get extreme negative. The MACD is declining and below zero. The small caps for the Elder Impulse are negative. The ratio between the small caps and the S&P 500 is really breaking down. The mid caps are also really under pressure, and with the Elder Impulse system are also negative. Here's the home builders holding up okay. We're declining with the S&P. We're also declining with the home builders. The ratio is still hanging in there. It's going down a little bit, but it is holding up for right now. We're seeing this relationship really start to go in opposite directions, and that could potentially give some support to the stock market, where if the home builders are holding up better than the broad market, once we finally find support, get really oversold and try to bounce up out of this, that could give a positive backdrop to the S&P 500. Here are bond yields. Just a few days ago, we're over 4%. Now we're dropping down into the 3.5% area. And here are bond prices, how they've really been going up. This also shows you how interest rates were going up overall and have now really started to decline. This is another ratio that we look at for measuring fear, and that is really going up. Looking at our long-term trend analysis, this is starting to become disappointing if you're bullish on the market. We're crossing below the moving average, and it's now heading back down below zero. Where we had been getting some hope from this is that this looked a little different than 2002, 2003, 2008, 2009, where the market was trying to go back up, broke through this trend line to the upside, but the MACD was not showing a lot of improvement, and then the market ended up collapsing after that. Because this MACD is starting to go down overall, that is suggesting that maybe this breakout is turning into a fake out. An update of our possible positive scenarios. This could add some positive backdrop to the market as well. The Qs are still doing well against the S&P 500. Discretionary is turning up a little bit, but not really doing as good. Large cap growth is outperforming large cap value. Then our growth value ratios, the large caps doing well, mid caps, and small caps. So once this mess gets done and we do hit support and an oversold condition, this could give some real thrust upward potential to the market. Our 50-period moving average of the highs minus the lows, it's still positive, but it's rolling over. And the indicator itself is now dropping down to a pretty negative level. The 19-day exponential moving average of the advanced decline ratio, we're getting extreme based on price and volume. Looking at the broad market measure of the Amex, NASDAQ, and the NYSE, we're getting more negative with our 5-period moving average of the highs minus the lows. The Treasury yield, after really going up, has been coming back down, so now we'll start to see, is this a spike that could give some support to the S&P 500? Our Staples to S&P 500 ratio, it still has a high spike up here that we're working off of, but this is starting to come back up, so we'll watch this every day. What's our outlook for Tuesday? The CPI will be released. On Wednesday, we're going to have retail sales and the PPI. The technicals are negative and short and intermediate term oversold. We have the NFIB Small Business Optimism Index coming out, and CPI will be the biggie. And then the whole list of geopolitical events. The focus right now is what's happening with this banking issue. We do have one speech that'll be conducted on Tuesday at 5:20 p.m. That'll be in Hawaii, but this happens after the market closes. Looking at our Stock Traders Almanac statistics for March 14th, we're positive with the Dow, but we're negative with the S&P and the NASDAQ going back 20 years. And then all of the other things that I allude to from time again, giving us this potential positive backdrop. Looking at the calendar, we're on trading day number 10, where we do see a little bit of weakness in the S&P. That's the green dash line that we're focusing on for the presidential cycle. But we're still in that sweet spot right now for the entire month, which could give some support to stocks. And here's another look at that same sweet spot. So our scenarios, you could potentially go with the down one because the ADX is starting to turn back up and the technicals are negative. But as I've said for the third time now, please be aware that we are oversold in the short term. There's going to come a level if we keep going down where bargain hunting may come into the picture and really be able to drive prices higher. That could produce some kind of a short squeeze and really shoot things up and take the market out of this deeply negative situation right now. But we can't go with the down scenario yet because everything is pointing down. If you're more conservative, you're still probably going with the sideways trend because the ADX is strengthening, but it's below 20 and the red line's on top, so it's negative. Our conclusion, the S&P is negative and oversold in the short and intermediate term. Long term, we're also negative because we're below the 200-day simple moving average. Never mind that we just had a recent golden cross. That may come into play at some point in the future. Thank you. I hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.